Welcome back, everyone, to Glam and Grind. We are on episode 15, and I'm your host, Rachel, and Julie is out exploring Europe. So we're doing a fun little summer series where I get to interview new, interesting people. So today on our podcast, we have our guest is Sharon Riddle, and she is a Montessori mom, just like Julie and I. And she has a 28-year-old daughter who is living debt-free and living her best life in Washington, D.C. She's a mompreneur, just like all of you that are listening. And she is into multifamily real estate. And she's going to tell us her story, how she went from single-family real estate investing into multifamily investing and all the things that she does as a mompreneur with her husband, who's also her business partner of 35 years. And she has her MBA. And I can't wait to hear more about you. Welcome, Sharon. How are you today?
Oh, I'm great. And I'm so delighted to be with you today, Rachel. So I guess everybody wants me to go ahead and get started on the journey.
I want to know all about the journey. So I want to know, Julie sent me some questions too to kind of help me navigate me because I'm brand new to multifamily. I know a little tiny bit from, Julie being my mentor, and that's the path that I want to get into. So as a brand new person wanting to get into this path of multifamily real estate, what would you say my first step would be?
Well, the first step that I would certainly choose is make sure you have solid mentors. You're part of a community, so you are working with people you trust and like and respect, because that is how Dan and I started. Even back in single family, we sought a mentor every stretch of the way. We started back in 2005. And move forward into multifamily in 2015. But I will tell you, some of the mentors who have been my mentors along that way, I am still in contact with, even after all this time. And we have been we've invested in 18 multifamily properties since 2015. Brad Sumrock is still our mentor. I am in his mastermind. Dan and I are. It's the Millionaire Multifamily Mastermind. And we're just continuing to learn even more in Raise Masters. So raising the capital and learning from some outstanding coaches with Hunter Thompson. So I have gone full cycle on about half of that portfolio.
What is that one? Raise Masters?
Raise Masters is actually another mastermind that I'm part of. And there are people who are investing in other asset classes as well. They have what is called a funds to funds model. So some people are operating a fund and some people are operating like me as an operator. So I'm a multifamily operator. So that is kind of the delineation within that second multifamily, that second real estate mastermind that I'm in. So that's kind of how, in a nutshell, very quickly, that's kind of how they're operating.
So kind of tell me your journey of, why did you decide to invest in single family initially, and then why did you then switch to multifamily? Tell us that path.
Sure. Well, Dan came home. He's in aerospace, and he had gone to a Managing Your Money seminar. And one of the things that was on the table was really more options trading. So you have other streams of income, and real estate. So real estate was kind of the winner for him because he wanted to have family time with our Montessori daughter, with me. And this was something we thought we could build. Plus, I am a construction brat. My dad was a construction subcontractor, had his own business, backhoe operator. So having tradesmen come through our childhood home was very common.
Yeah.
And to this day, I work with a lot of, even for my my personal home, my residence.
Mhm.
I'm the one who has chosen the contractors that I work with. And I did that with single family as well. So I self-managed. So
Okay.
Dave and I worked in the business, but he continued his W-2 job. I ended up being the real estate professional and just really managed those myself. Initially, we did have a realtor, but quickly made the assessment that I really could do a better job than that. And then I got the job. So I kind of kept the job because I could track the cash better
Mhm.
and do the banking. I could do the leases. I was getting people into single family residential rentals quickly. And then over a 5-year period, I was really building that team. So we
So
had,
you got your real estate license through that process?
I did not get my real estate license as a real estate professional and as somebody who owned our own portfolio.
Mhm.
I could operate that portfolio almost like an operator in multifamily, but
Okay.
on a smaller scale.
And
So
when you say you built a team, what do you mean by that? Explain
with
that.
the team, I built handymen,
Mm.
I built general contractors. We had some realtors that we did work with to sell properties on the back end. We weren't
Okay.
doing the for sale by owner. And I worked with some realtors on the front end in the acquisition. We
Okay.
did pick up some properties that were HUDs, that were real estate owned. And so we did have some realtors who were in the mix regarding those acquisitions. And Dean and I also worked with private lenders because in 2008, there was more of a credit crunch.
Right.
Banks weren't loaning for real estate investment properties. And so we went to an Alan Cowgill boot camp and we learned how to work with private lenders ourselves, which we did. We had some friends and some family and some neighbors that ended up being our private lenders. And so they got the distribution checks monthly. That's how we operated that. And they came along from project to project. In fact, one of my early private lenders was my late father-in-law, Charles
Oh,
Riddle.
yeah. So then you had single family and you were doing great with that. And why did you make the switch then to multifamily in 2015? You survived the crash and then
Survived
you
the crash
decided.
thanks to Alan Galgill and his techniques. And it was the scalability. At that point in time, after 2008 timeframe, we really were not getting the scale. We had so much appreciation in Dallas Fort Worth area, which is great if you are a seller. If you are a buyer, it is a little more challenging. And I had realtors I was working with regarding acquiring property.
Mm,
We
okay.
were going out, we were making offers on property, and I will tell you, homeowners were snapping the properties up even with as much rehab that was being required. They
Mm,
were just, in my estimation, they were overpaying.
yeah.
They were overpaying. There were even some investors in that space that were overpaying. And one of the things that we were taught early, certainly Alan Cowgill reinforced this, that we operated to a formula. It's just like a business.
Hmm.
That's how you ran the acquisition.
And
You
what's that formula?
Well, it was really more of paying 70%.
Okay.
So you have to have your rehab and you have to have your initial acquisition, and you just really you can't pay 100%. It's never going to. The numbers are never going to work. The math is never going to work if you overpay on the front end. You won't make it up on the exit strategy.
Okay.
You just won't. It won't work.
So what is your investment strategy?
Regarding single family or multifamily.
Multifamily.
Okay, well, regarding multifamily, we operate. We have an underwriting uh, analyzer that we utilize, thanks to being in Brad Sumrock's community since 2015.
Mhm.
And we just really kind of plug through the numbers. So what we take a look at, and we really determine what will the market bear. And we want to keep our underwriting very conservative. So we take a look at what other properties are selling for that are the comparable sales. And we take a look at what the rents are. And we just have, we have a whole, well, it's like an analyzer, and it has line item detail on what you would be willing to pay for the property. So
Okay.
it's like its own software. It's self-contained, and that's what we have been utilizing with Brad. And even within his community, when we invested, the sponsors show the analyzer. So we're always going to look at the detailed information, as well as some of the attributes of the market. You know, some of the things that some of the things are very similar. You're really wanting to look for strong anchors, and we did that in single family. So you're wanting to have this, shopping.
What is a strong anchor? Tell me what that is.
A strong anchor is you can have shopping, easily accessible, employers in the area, churches, movie theaters, things that people are going to want to seek out that are going to give them high quality of life.
Okay. Okay. So what has been your track record in multifamily real estate?
Well, I have had, as far as my passive investments, I have had several that have gone at least 3 times on the return or more.
Okay.
So I've had some really strong
On your exit.
on my exit.
Okay.
On my exit.
Mhm.
So we've had really strong performance, and we will see how our performance is post-COVID.
Okay.
That has been a more challenging time. The 2015 time up to COVID was really, I don't know, I guess I would call it more the fat and happy years, because you could really make money pretty easily.
Mhm.
And now what I am seeing with sponsors and in the whole multifamily space is tightening up, not only regarding credit, because all those interest rate hikes,
Yeah.
and debt availability, but I am also seeing stronger, which is a good thing, stronger asset management practices coming into play, because some of the sponsors who were not as strong in their asset management,
Mhm.
or they were bringing in preferred equity debt. Some of them have not made it to the exit. Some of them, sadly, have gone into the foreclosure category, and it's very sad to see some of the people that you have known or you've at least been in a room with.
Yeah.
It's sad. It makes me sad.
Yeah. Okay, so tell our listeners the difference between passive and active income when it comes to multifamily investing.
Okay, well, passive investment is normally when you are a limited partner. You could also be a key principal, and we have been a key principal. It just means as a key principal, you're signing on the loan.
Okay.
That is the difference. But passive, you're really investing a certain amount of money. And what you will do, you won't just let it sit there and say, oh, I'll get my money one day. You are going to actively be reviewing those monthly reports. And since I had previously been a financial analyst and a business analyst, that's my job. I'm going to comb through those things. I'm going to see what are the drivers in that particular property, because each property is its own business. And to be a respectful and a useful passive investor, a well-educated and savvy passive investor, that's your job. You've got to do that. You've got to do that every month to make sure that everything is going on track. You can talk to sponsors too if you're not seeing some of the results you would like to see. But first of all, you do need to see what's going on every month, so you are well informed.
So what if you're someone like me and you're like, I just want to know a summary. I don't need to know all the details. You just tell me. Are there people out there that, we would contract with that would help us with those monthly reports?
Well, you could. I've just had part of the background to do it. So um, the thing is, Rachel, there are certain tasks that you can offload.
Hmm.
You can get a VA for, and there's certain things that I personally believe that it's good for you to know, have your hand on the pulse.
Yeah.
So, and this is just one of my little sayings. I believe everybody has an inner analyst. They really do have an inner analyst, and they can learn the basics of what to do. Even if you're just going through the monthly report and you're skimming some of the highlights, because they'll have some executive level summary information, but some of the drivers of the business. It's just a business, it has its own language, and you can just quickly go through and see, hey, what's my occupancy? What are some of the, what's the net income? What are some of the expenses? And just kind of quickly go through that. And you're not just going in the middle of the weeds and suffering.
Yeah.
You don't have
So
to.
it's similar probably to, like a business report that I do monthly. I'm looking for payroll. I'm looking for building costs. I'm looking for the big numbers.
You are.
And
You
then
are.
the little numbers we watch and manage, but it's not as important as those big numbers. So it's probably
See,
similar to that.
well, that's a transferable skill right there, Rachel. I mean,
Yeah.
it really is. It just has a different language, and some of the expenses and some of the income is just reordered in different places. That's kind of a simple way of how I look at it.
Hmm. Okay.
Yeah.
So tell me now, first of all, do you still have single family or have you switched completely to multifamily?
As of 2019, we sold our last property.
Okay.
So, and we sold it in an appreciating market. We had some long-term tenants. We did have to sell it. I said, sorry, it's the time. This is the time for us to exit. So we did our exit before COVID.
Wow.
Yeah. We
Every
didn't,
time
we didn't
somebody
plan
tells
all of
me
it
that,
that
I'm
way,
always
but it was a good time.
when
What's
I
that?
hear you sold your business or you did that, your exit before COVID, I'm always like, yay, you didn't go through the fire of COVID, but that's good.
Well, I will tell you, I have had a handyman at my home,
Hmm.
and he's working on retiring out, but he is also a partner in a real estate property management company, and some of the portfolio is single family. So he was suffering. He was giving me a report out because he's like, "You understand, Sharon? Just let me tell you about what's going on for me." And I'm a kind-hearted person, so I listen. I'm like, "Wow, I'm sorry you're having to go through that, but." It's tricky for some people. It's tricky for some people in multifamily. And there's still some challenges as part of the aftermath of COVID.
Hmm. Yeah, for sure. Okay, so what is your due diligence process? This is the part that I love and hate as far as acquisitions go.
Yep.
So, how is that process with multifamily?
Well, with multifamily, and I will be very candid. At this point in time, our team is still on the hunt. That's what I would say.
Hmm.
We're looking for that first acquisition as a general partner team.
Hmm.
Some people on our team have already had acquisitions, but part of that core team that's diving into some of the underwriting has not quite. My partner and I have not. Our partner, who is the microelectronic engineer, has. So he has a smaller one, and then we have other people who've had larger acquisitions, multiple acquisitions. But just really going into the property itself and determining the condition. So,
Physically, you have a team that goes in and physically inspects.
yep, 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 yep. And
Okay.
we have a person that we work with regarding the due diligence. So there's a professional who walks the property with us. in Dallas Fort Worth area. They walk it with us, and you're going through all of the units.
Mm.
I mean, on the tour, we take a look at a sample of the units, and we also go to the common areas, like the pool or the clubhouse area or the leasing area or the shop area. So on the tour, you go through those. But when you're doing due diligence, you go through every single unit, every space that is on that property and the grounds.
Wow.
So that is what you do. You do it all, and you determine what condition everything
How
is.
long is your due diligence process for a multifamily?
Well, at this point in time, since we have not fully completed that cycle, I will say there is a certain time period per the contract that you are allowed. Typically, it's like a 2-week window. I mean, you're fortunate if you get a longer period to really walk through. So it's a quick turn, because you've got to make that assessment very quickly. You've got to have the team in hand who's doing that. And part of that team is the contract hand. That's the contractor that is performing the due diligence for you.
And what about the financial due diligence? How long does that process take?
Well, basically, you have to turn some of that around after you complete the due diligence. What you're really looking at, you're determining if your conservative underwriting, we like to be conservative because it doesn't cause us any problems, but just see if those numbers do indeed reflect the condition of the property. If there has to be any adjustments, those adjustments to the underwriting will have to occur at that point in time. It'll have to be a new snapshot if there's any discovery that occurs. And if that discovery is very material, there has to really be a renegotiation.
Okay.
Yeah.
So
Because the property is not in the condition that it was advertised really to be in.
right.
So, and that's messier and trickier.
Yes. I've had that happen with acquisitions, going to the very end and then being like, oh yeah, no, we got to renegotiate.
We found something, or you've had debt. You've had that underwriting, that the term sheet. Some things can change in that during that time, and that's another tricky component.
Yeah.
It's not only the property, the due diligence, but also what are the terms of the loan? What are those going to settle out to be?
Right. Okay, so can you tell everybody what the difference is between a GP and an LP, what that stands for, and that whole?
Sure. A GP is a general partner. So the general partners are more active in the operation of the property on a day-to-day basis. They work with what's called the PM, which is the property manager. So that's the third-party property manager that is hired to come in and operate that particular property. For some teams, I have seen where there've actually been like a steering committee versus if it's a larger team, only because the debt has been higher during this time period because of all those interest rate hikes.
Right.
Yeah. And because they needed to capital raise more. It is, in my estimation, since I've seen that as an LP, which is a passive investor, I like to see a smaller team, period, if you can raise that capital successfully, because it's just a lot of people to have to really work with and make sure that there is consensus as far as the decision-making process.
Too many cooks in the kitchen.
Too many cooks in the kitchen. And I have seen that on a property, beautiful property in Arlington, Texas, but a lot of cooks, a whole lot of cooks.
So I've done some obviously commercial real estate because that's how we operate our business. But how are you in one of our buildings that we just bought does have that high interest rate. So how are you navigating that with this landscape right now, like you talked about that a little bit with the high interest rates and, raising enough capital to surmount the debt and all of that. How are you navigating that right now?
Well, right now we're really ensuring that we are staying conservative in our underwriting. And then
What do you mean by that? Explain that a little bit more.
well, it just there's a certain price point that we're willing to ask. I mean, we're willing to acquire a property for.
Okay.
And we agree upon that as a team. So we get our term sheets. We know what, at least at that period of time, what the debt is, because that can change, certainly to the point of close. But you just have to be in that particular zone. And then we have some other people that are coming in. We even have a collection of people who have been sponsors or GPs on properties we've invested in the past. And we even bring them in to take a look at our underwriting to see if we are on target for the Dallas-Fort Worth market. And we also have coaches that review our underwriting through Brad Sumrock's personal mentoring organization.
What does a sponsor do?
Well, the sponsor takes a look at what is working on the property, and they are looking to see that both the capital expense portion of the budget and the operating portion of the budget are on target per the business plan, the business model.
Okay.
So that is exactly what they do.
And where do you find those sponsors?
Pardon me?
Where do you find those sponsors?
Well, we've been in Brad's group for some time. So we have a lot of connections that we've had. I am in a discussion with another person who is, she's part of two different mentoring groups that I'm part of, mastermind groups. And so we're actually in a conversation regarding that. We've had our initial meeting via Zoom. I'd had a meeting prior to that, and we're going through a discussion, basically, because it's not only just the experience that people have. Are they comfortable working as a team? And right now, this person has some excellent experience. She's been a banker. She's a CPA, and she's also making the determination how she would function within a team, because any of her acquisitions have been solo acquisitions.
Oh, yeah.
Yeah. That is, that's a change in operation, moving forward. So we're talking about that. We're going through and talking about that. So, and I've got another person that I'll be talking to probably the 19th. First of all, it's kind of like, initially, Rachel, it's kind of like going on a date. You haven't known.
I don't know what that's like. I've been married for my whole life.
Well, I've been married for 35 years, so it's been a long, long, long time. But it's just determining how things are working, how they operate. Just are they people that you want to be around? Because it is like being married. It's like a business marriage. And so how are they going to weather when things are challenging day to day? So there can be some challenges that crop up. And how are they going to operate in those circumstances? Because we do have some people we've known for a long time, and we've seen how they operate in different scenarios. But it is really interesting and challenging going through and talking to a person who is very new to you, and they have some wonderful skill sets.
Yeah.
And they just seem so likable too as a person. So that is that's part of kind of what we're going through with that particular situation. So that is challenging, but I think in a good way, because we're learning how to do that also.
Yeah. Do you have almost like a, not due diligence, but I can't think of the right word, but almost like a due diligence process for how you are getting your partners and how you are getting your sponsors and raising capital? Do you have a process for dating these people, or how you gain these people on your team?
Okay. Well, we're going through interviews, so we're doing that.
Mm-hmm.
But we are part of our core team who have known each other for so long. We initially met through Brad's group. We also were in a meetup, so we had more than one touch with each other.
Yeah.
We were on some of the investments together as passive investors.
Okay.
So we're moving forward in general, a general partner relationship when we've been passive investors together
Mm-hmm.
with sponsors. So we've done that. And we've seen, one of the good things is we've seen a lot of best practices occur in our investment over time. So we are carrying that forward with us.
Mm-hmm.
So that's part of what we're doing. I will say we actually, way back, even in single family,
Mm-hmm.
when we were investing, and Alan Cowgill told us there are going to be investors that you will eventually have to fire. I never thought that was a thing, but he said there are going to be people who are just so disagreeable for you to do business with. You're going to have to let them go.
Yeah, that's interesting.
And it did happen.
Yeah.
I was like, wow. And some were friends.
Mm-hmm.
So we worked very diligently to keep a longer term friendship and yet not keep a business relationship.
Mm-hmm.
So we
So in
did.
that scenario, do you buy them out of their piece? Is that how that works? And then you say, sorry, but no longer we can have you as a partner. Or do you wait until your exit and then they get paid out at that point? How does that work?
Well, on some of them, we did wait until there was an exit.
Mm-hmm.
So we kept that going. They went from one project to another.
Okay.
But there were fewer projects we moved them to.
Okay, that makes sense.
So it was kind of a slow process. It wasn't just like, we're cutting you off, you're dead to us. We didn't do it that way because just like family and friends, they require different care.
Right.
Different care. With other investors, though, you can do that in a kind way too. But you're like, well, we just don't have a project that we feel would be a good fit for you as an investor.
Mm-hmm. Okay, so one of my philosophies or whatever in business is raise the value, raise the price.
Right.
So what are some things that you do to raise the value for your tenants' lives?
Okay. Well, in single family, we did a lot of renovations.
Mm-hmm.
So upgraded. Our philosophy was mechanical first,
Okay.
then some structural. And most of the time, we were fortunate. We didn't have a whole lot of foundation, but every once in a while, there was some where we had to drill some piers, work with a foundation repair company, and do some piers in between, because the soil in Arlington, Texas, it's that's the way the soil is. It's Texas. It's kind of rocking, but so we would have to do some of that and be very very diligent about the price point on that too.
Mm-hmm.
What are you going to pay per pier? So we did a lot of that kind of stuff. Moving into multifamily, it really is driven a lot by the business model. So you're going to be operating really the two-prong approach. There's going to be the maintenance. So you're going to have a tenant move out. What are you going to do with that property, that particular unit? Is it going to just be a make ready, or are you just going to turn it and it had the same kind of finish? It had the same kind of appliance as before? Or is it a unit that's going to really be upgraded as part of the capital expense budget? So different strategy, because you might have to trade out some appliances or at least some facings, like appliance faces. So sometimes you don't pull out and put a new appliance in, you just put a new finish. So
I didn't know you
yeah,
could do that.
yeah, you can do that. Yeah, you can. Yeah, I learned that in single family.
That would have saved me a lot of money over the years. I'm like, I want a new one. I don't like that color.
Well, you have to determine, how old how old that appliance is too.
Mm-hmm.
So if it is closer to the end of its useful life, it may be you may need to pull it out. You may
Yeah.
need to replace it. But if it's a newer appliance and you're wanting an upgraded finish, like especially for kitchens, then yeah, you can buy those appliances. And facilities people know how to do that. If you have a really strong third party property manager, uh, they're good facilities people know how to do that kind of stuff.
So what now, you talked about these are the things that you add value. Now, what is your communication strategy when you're doing all of that? And then your communication strategy in general for your team.
Well, the thing is, like, it's good to use the monthly report when you are working on those items that are part of the operational budget or part of the capital expense budget that you're upgrading. And a lot of times in many monthly reports, I've seen where they do split that out. And if they have capital expense projects that are currently they're pending, they'll show that. I've even seen where some sponsors will kind of do almost a dot plot.
A dot plot?
They'll do a dot plot. Yeah, I have seen that.
What is a dot plot?
Well, it's just where they're showing basically where the rents are going. So it's like a curved line, but you have your little dots where the exact expense numbers or the exact income numbers fall. But they're showing you the whole curve. They're showing you the trend.
Okay.
I warned you. I'm a real data freak regarding this stuff.
Okay, so now you talked about data. Obviously, you love data. That's your first love. Because of that, do you know Enneagram? Have you ever done your Enneagram?
No, I don't think so. No, I may have done something like that way back when I worked for a transit company, where kind of where my traits usually fall.
Yeah. I would be interested to see, because I feel like you'd be like a 5 or a 6, because those are the ones that are like analyzing everything. But
in the particular test that they administered to us, yeah, I was falling definitely in that quadrant.
And you need those people on your team for sure.
Mm-hmm.
So because of that, because you're able to really foresee the things that might come up, what is your approach to risk management?
Well, I think that you really have to stay with the numbers. You can't have a lot of deviation from your plan unless you do have an event like a fire.
Okay.
Hail. It happens in Texas for sure. When you have some kind of events, you've got to have a strategy to work through the event. So you've got to do that, but try not to have too much deviation. And as my aerospace husband and partner, Dan Riddle, says, deviation is the enemy. So if you have too big of a gap between, what you're doing on your business plan versus where operations are falling, you could have an event where it's just hard to recover. Mm-hmm. Really a struggle to recover. So you've got to keep it really, really tight.
So speaking of risk management, if you're getting into multifamily real estate, what could people expect to spend out of their own money to invest in these deals?
Well, it depends on the property and the offering. Some people are wanting to only offer to accredited investors, and usually that minimum threshold is $75,000.
And tell us what an accredited investor is.
An accredited investor is an individual that typically does have a net worth of at least $1 million.
Okay.
And they usually are higher net worth individuals as far as the income they're earning. like
Meaning like annual income.
annual income.
Okay.
So maybe there are people who fall within like a $250,000 or $400,000 annual income, something of that nature. They definitely wouldn't be people who are at like $100,000 a year. They're going to be at a different and a different bracket, different tax bracket, I guess is the easiest way to explain that. But if you have an offering where you're deciding, well, as a team, you're going to have some sophisticated investors as well as accredited investors.
What's a sophisticated
A
investor?
sophisticated investor is one who has had some investments, or they have some cross skills that really work well as far as investing and understanding the business, because it is a business. I will tell you, Rachel, that engineers really fall into the profile so often, because I have been in a room full of mostly male engineers in multifamily at events. Even now, as a woman, I'm about 20% or less at any event, either Raise Masters or Sumrock events. Yeah, it's a lot of men, a lot of technical people. So it's going to be like your IT people or your engineers or your aerospace people, kind of like fit the profile of a couple of my partners, and and not a whole lot of women.
Yeah.
However, women possess many skill sets and many traits that work really well as investors, and they are more conservative investors. So if you have a conservative underwriting that you're working on as a team and as general partners, don't ever leave out women investors, because they will be with you on that journey, because their mind goes in that direction.
So what would you say to a woman specifically a woman who's wanting to get into multifamily investments that is an accredited investor?
Well, first of all, I would really ask them, what are their goals? I'd like to really, see what are what outcomes, what are the desired outcomes, because then you can kind of reverse engineer back to that. What are your goals in your life, and what are your goals with your wealth, with your money?
Yeah.
So I'd like to really find out what they're wanting in both those spheres, because then you can understand and kind of tailor investments to them, or at least talk to them about how the business plan of your acquisition fits within their goal structure and within their dreams as far as wealth building and their family's dreams.
Yeah. So you mentioned tax strategies before, and we talked a little bit about it before we started recording. So let's say that you want to help somebody with tax, that's their main reason for wanting to get into multifamily investing to start. So what are the benefits of tax strategies with multifamily investing?
Well, what I have discovered in working with my CPAs, and I'm on my third CPA, so the third time is more the charm, because I really worked with CPAs who understood real estate and understood that I needed a tax shelter because of all the acquisitions we'd had, both in single family and in multifamily over the years. Tax sheltering, tax strategy is huge for me. So I would just really basically talk to them about, kind of ask if they didn't mind sharing their current tax position, and do they want to shelter more? Do they want to pay less tax? Are they willing to have some other offsetting investments that do that? And also, say my disclaimer, I am not a CPA. I'm not a tax strategist. I can only discuss what we have seen and what we have used in the past. And I can tell them the name of, my CPA firm, because they do that kind of thing. But I do have quarterly tax strategy conversations with our CPA, because that's such a huge component of what we're doing. Not only the investments and getting that right, but also not overpaying regarding tax.
Right. Yeah.
I never thought I'd be in that position, but it's a good place as long as you have the professionals that know how to work that with you, the sponsors that can help you regarding the timing, because then you can you can just really upgrade your portfolio, even as a passive investor. And that's what I would say to your audience today. You can really start off with some B or C class, and you can upgrade that more as you go along. You could have certain properties you'd like to really be in those submarkets, or like the look of what that unit brings, or that year built, and that's certainly what Dan and I have done over the years. We have continued to not only redeploy our assets, but also upgrade from where we first began in 2015. There's a lot of fine properties that we're invested in that were not what we initially sought, because we could upgrade because of the wealth generation and the appreciation that had occurred in the property over a 5 or 7 year period.
And that's exciting to
It
me.
was very exciting.
Okay, so how many doors do you own currently?
3,507.
Wow, that's fabulous.
Yeah, pretty good.
Okay, so tell me what your exit strategy is.
Well, basically, what we're doing, and all of this is timing the market. So the properties, typically they're a 5 year strategy. I've had some that are 7. In fact, the 12th, I will be on a webinar to discuss another property, and this will be an LP property, a passive investor property, what that exit strategy will be for that property. That is a wonderful property in Columbus, Ohio. So we'll be talking about what that's going to look like and timing. So that's pretty much what we do. And those are the conversations that I do have with my general partners in my passive investments. When do you think, how is there any change in the exit strategy? Is there any change in the timeline? Of course, I'm going to ask those kind of questions because, well, I'm an analyst. I ask those kind of questions, whether I was an analyst in a corporate environment with retail sales and stores, or in a transit authority, or in not-for-profit. I will ask those kind of questions because that's just part of my cross skill, what I've experienced in my life, in my investing as well. That my investing has taught me so much more even than my MBA or my previous positions before I was a mompreneur. Those are the things that I'll ask along the way. Just see if we're on track. What are the expectations? Because you do have to time all of this regarding tax impact as well.
Mm-hmm.
Yeah.
So you are talking about multifamily, which is apartment buildings, I assume. Yeah. So what is your experience as an investor? Why have you gone that route versus commercial or storage? Or, we talked about single family, but why not commercial or storage investing?
Well, in the time period, and I am actually in rooms where we have storage investors now, and light commercial, light industrial, a lot of those, which are really intriguing me a great deal.
Mm-hmm.
However, we made a conscious decision in 2015 to look at multifamily. Dan and I did. And in fact, we had an introduction to Brad Sumrock from a single family coach and mentor in the Dallas-Fort Worth area. So we went to Brad's first event, called Rat Race to Retirement in 2015, because of our relationship with Dennis Henson, longtime coach. So we were introduced into that asset class by another mentor. And at that time, 2015 was such a excellent time to invest because you had the lower interest rates, you had appreciation, certainly in Dallas Fort Worth, and in what is commonly called the Texas Triangle. Texas Triangle is Houston, San Antonio, Austin, and Dallas Fort Worth.
Okay.
That's kind of where a lot of commerce occurs. So that's why they like to call it the Texas Triangle, because a lot of people live there, but also a lot of businesses are conducted in those zones.
Okay. So, what is commercial or storage something that you would ever go into in the future, or you want to stay completely with multifamily?
I would certainly be, I would certainly want to investigate that, and
Mhm,
I am in around people who
mhm,
are doing more of that. So what I would do is I would determine what is their business language. It's kind of like a separate accounting system.
mhm.
Okay, what are those key metrics? How do you determine what the performance is? So I would have multiple conversations to understand in a deep dive weeds kind of area because I'm kind of like that. I'm a weeds in the weeds woman, a data driven woman, and find out and discover um, how that operates, not only on a cash flow basis, because another asset class might be very useful to complement
Right.
multifamily. So
Because
you
it's
have,
more of an active income.
well, it would be more, would be more active income versus really tax sheltering
Mhm.
and longer term growth, because multifamily is longer term growth. It is a longer term gain, and I do already have like a triple net fund. So I do have that. And
Okay.
what this fund invested in, it was a person that, I was one of my sponsors, and he decided to open up a fund. And they have bought Family Dollar, and all of the really more budget. They don't. Now they're starting to serve produce, but
Mm.
the General Family and the Family Dollar, and even they're even entertaining car washes, and where there's just a lot more cash flow
Right.
going on. So and auto zones.
Mhm.
They've had some auto zones. So they've had some of those that have been in some smaller towns in Ohio and in Texas, and and they generate cash. I get like a monthly distribution
Mhm.
on those particular asset classes.
So you have started that.
I've started that. I was actually introduced to it by a sponsor, and I had a multifamily investor friend that honestly, she kind of lovingly nagged me into that because she goes, "You are going to want the additional cash flow too." And so I'm like, "Okay, okay, okay, Brenda, I'll do it. I'll do it." And so that's how I kind of found my way into that, which is good. And I really kind of like how that's operating. I would just have to find out how I can seek out those other opportunities, and how did they perform.
Yeah.
You have to find out how they perform, talk to some other people who have invested. So I would ask other investors as well as the sponsor, and just see uh, what they what they have to offer, and what locations are those particular assets in. You
Yeah.
know, yeah.
Okay. So, do you have any questions for me as we wrap up? And I have one more question for you at the end of our call.
Okay. Well, Rachel, how do you see your path in multifamily? Because you have been an entrepreneur in a totally different businesses. How do you see your path moving forward, and how is that going to what's that going to look like for you?
Yeah, so we thought about single family, but I've talked to so many people about single family versus multifamily, and it's more you talked about property managers being your operators basically. And I don't want to do the whole construction thing. We've done that. We've bought and build, 10 buildings, and we don't really want to do that with single family. So multifamily is attractive to me on that part of it, as it being more of a passive, not being actively involved in the upkeep and remodels and all of that like we've done in the past, because we've done all of our remodels, and that's a lot of physical work. So we want more passive income. But also at this stage of our lives where we're growing our business, we need more of that tax shelter, like you talked about,
Right.
and more of those tax strategies. So multifamily is something that's very attractive to me, like in the immediate future, for the tax sheltering piece of it. And then in the later future, as we get older, we want that to be more of our, like you said, the race to retirement, more of our wealth strategy for our exit for retirement, but also for our family. As
Right.
we grow, I want to build legacy wealth. That's not something that I ever knew was a thing. It's not something that my family did, and that's not something I really learned about until I met Julie. So my goal is to build legacy wealth for my family, and it's not just something that we have for us, in our lifetime, but that lives on past us.
Right. And I can fully value that, because we are going to be creating an additional LLC where our Montessori kid, the 28-year-old daughter, Nora Riddle, is going to be a partner.
Awesome.
So she's going to be on a part of that wealth journey separately. So she can read monthly reports and she can learn all the skill set that I've developed over time. And she was the person who helped me with tax preparation regarding single family. So she was very helpful. She's got a lot of really great skills. And I want her to be able to experience that fully herself, not just mom and dad creating wealth. And I talk about my wonderful general partners and my mastermind events and things like that. I want her to have this really hands-on skills. And then as adult women, we can delightfully talk about the performance in that particular asset and how our properties, how our businesses, what's going on with them, what's the performance. And I think it would be wonderful.
And you talked about your daughter being debt free. My daughter, who's 22, almost 22, and just graduated college, is also debt free, and I would like her to continue that as she gets married and buys a house, and would like for them to start to invest in multifamily as they at this young age. And we've even talked about my younger son, who's just now going into college, about having him flip houses or something to where he's also building his wealth and starting investing young too. So
Right.
it's something that, like you said, you want your family to build the legacy, not just you, not
Right.
just you.
Exactly.
Yeah.
And since Nora is a consultant, she really does have the skill set. And she's around a lot of people in Washington, D.C. And her coming out with no debt
Mm.
is, I mean, it's more of an anomaly than
Yeah.
I would really like to see that. And it has put her in such a strong position as a young professional woman.
Mm.
You know, she actually does all of her own budgeting. She even helps some of her friends with budgeting so they can really increase their budgeting skill set, and so they can have a higher quality of life as well. So she's a very generous friend in doing those sorts of things, but she learned how to do that at an early age, and she learned how to really do that in college when she was coming through college. I will say also that at the time when she was in college at the University of Denver, we sought out a national expert in grants and scholarships. I met this individual, Christopher Stevens, at a real estate event. It was an Alan Cowgill event. Well, I was looking for that sort of skill from a professional, and they did the research. And when we were trying to negotiate what Nora's tuition would be, I presented the data that his team supplied me with that particular university and what scholarships are available.
Wow.
And I think it really strengthened our position in requesting a partial scholarship,
Yeah,
which Nora had.
that's awesome.
Yeah.
All right. So at the end of all of our at the end of all of our episodes, we do a health, wealth, and happiness tip. So do you have a health, wealth, and happiness tip for our listeners?
Well, the health portion of the tip, I will say I do meditate. So I meditate.
Mhm.
I do some mindfulness lessons because I like to keep myself feeling good and performing at a high level, but also in a very happy frame of mind.
Mhm.
Sometimes during the day that might ebb and flow a little bit, but help myself reset more quickly when I'm like, oh, this is not the zone I want to be in. I need to do something to reset.
Right.
So that's what I attempt to do every day. Some days more successfully than others. That's the way it is. But I'm continuing to work on it. It's a journey, and I'm working on that process. As far as health, I have hired a trainer. His name is Andre Shook. We were at a mastermind event that was also a fitness resort. And so that's how I met him. He has some awesome credentials. He is working on a master's degree in sports medicine as well at the University of Connecticut. And so he's just offering even more to me. We really do the deep dive into nutrition.
Mhm.
And my daughter Nora and I were talking about this, that women aren't always educated and socialized the same way that male athletes are. You know, that's kind of an incomplete part of our education.
Mhm.
And so Andre has taken the time to kind of re-educate me. Instead of just going into calorie reduction, we're talking about nutrition and nutrient dense foods. And I'm really happy about that journey. So we're going to keep working on reducing weight, but we're also going to be doing that in a healthy way and increase my activity level and the kind of movement that my body engages in every day.
Awesome. Now, what's your wealth tip?
Okay, the wealth tip is I'm pretty high on real estate. So I really feel that real estate is a wealth generating machine.
Mhm.
Now, you and I have talked about there could be some coupling of different assets to
Right.
get all the portions, all the puzzles in your real estate investing portfolio up and running the way you do. It's always something that you tweak throughout your life. I firmly believe this. There's other asset classes I will continue to investigate. Multifamily is a long term wealth strategy and a really awesome tax shelter. But I have included some of my little triple net too, and I'm going to be looking for other things in the future.
So your wealth tip is that real estate is a wealth generating asset, right?
Well, it is, and guess what? It makes money for you while you're asleep, just like Warren Buffett always talks about. You need it.
That sounds like an amazing thing.
Yeah, yeah, really good.
All right. Well, it was so nice having you on our podcast today. And I hope I get to talk to you more in the future about multifamily real estate, and have a good rest of your day. Bye,
I
everyone.
really love that, Rachel. Thank you.
Bye.
Bye.